One word that you've been hearing kind of on and off all day is the word innovation. And just like Kimberly spoke of getting to market, or fast innovation being applicable in many different realms, from manufacturing to business processes and accounting. Innovation comes in many different respects. And one gentleman who is applying innovation to finance is our next speaker, Teofilio Tijerina. Teo has started a group called EDCO Ventures, and EDCO is facilitating and I guess assisting and bringing along tech-based ventures in the South Texas region. And these kinds of operations face unique challenges compared to other parts of the state and the country. And EDCO Ventures is very sensitive to those challenges and has an established record of overcoming them. So next up is Teo. He's going to walk us through the best ways to raise capital for tech-based ventures in this region. Teo?
Good afternoon. Buenas tardes. How are you guys doing? Good, good. Well, first of all, I want to introduce, there was two people that are going to help me out with this presentation. The first person is to my right here. Her name is Mayte Mitre, and I'm going to read a quick bio on her. Bear with me for a second. And the other gentleman, Jaime Aguirre, who is a venture manager for a very big venture capital firm here in Texas, Austin Ventures. He's driving here right now. Will probably join us halfway through, but he will at least get a chance to introduce himself and will be available during the break for any questions you might have for him. But I will go ahead and read a little bit about Mayte, because she's a very impressive individual. Mayte has more than 12 years of combined experience in marketing, sales, finance, and business consulting. She has led companies from startup and growth mode, serving as a board member of various boards of directors and executive committees in her native country of Panama. She currently lives in Houston, Texas, but she spent most of her career working in financial and banking industries, including retail, commercial, and small business sectors. Among her significant previous positions, Mayte was vice president of Banco Delta in Panama, a microfinance bank that she helped start. She opened the bank and designed all the marketing strategies, products, marketing channels, and so forth. In addition to Banco Delta, Mayte worked as finance manager for Grupo Financiero, currently owned by Citibank, and she was headhunted to increase effectiveness in the finance department of that organization. She also led the regional expansion project for the establishment of new branches in Central America for Grupo Financiero and a group of closely held companies engaged in consumer finance and leasing businesses. So, let me see. She's an adjunct. Sorry about that. She's currently an adjunct faculty at Houston Community College and instructor at the Small Business Development Center, and she runs her own private consulting company now called Pandora, with focus on Latino, Hispanic markets, as well as Latin America business, which is more into the interior of Latin America. She holds an MBA from an international management, she holds an MBA in international management, international trade and finance. She was a Fulbright Scholar alumnus at Boston University, and that's Mayte. So, welcome. And I'm going to just mention a few words about EDCO Ventures before we get started. We're based out of Austin, Texas. Our mission is to help launch innovative companies, high-growth companies in economically distressed communities, primarily low-income communities that need levels of entrepreneurship that has historically not been there for many reasons. So we focus on working with local institutions, universities, chambers of commerce, entrepreneurs, working with intellectual property owners, even outside the region, and entrepreneurs and capital groups And we sort of see ourselves as a catalyst group that helps manage the project from inception. We work at very early stages and get them to a point where they've raised capital, they have a strong management team, a strong board, and the company can thrive on its own. And then our idea is that we go work on the next company. That being said, I'm gonna go ahead and start here covering what we want to cover today. This is going to be basically the content of our presentation for today, is really trying to understand what funding goals someone might have when they're starting their company, what type of capital is out there for startups, and how each type of capital primarily works, because they all work very differently, equity capital, loan capital, and just explain a little bit about the industry. Generally speaking, the scope of our presentation for today, we're not going to get very involved in the strategies piece of how you really talk to investors and how you position yourself. We're really trying to focus more on sort of understanding the different company stages, understanding the different capital stages of businesses, when you might want to solicit different types of capital, and just the basics of how that capital works. And the reason we designed it this way is I was remembering when my partners and I started our first company in El Paso, and we were engineers, worked together in a manufacturing center, and we started a company, and there was just so much we didn't know about just the basics of finance, the basics of startups, and how just, unless you come from a family that has already started a business and has a culture of business in your family, or unless you have a strong an MBA, which not all entrepreneurs do, there's just a lot of basic information that we wish we would have had when we got started. So that being said, there we go. I think the first thing that when you're starting a company, because we get this a lot, we get a lot of folks who call us and say, hey, we read about you in the Austin Business Journal, or we saw your webpage. The first thing that the entrepreneur really has to identify is what type of company do you want to start. And they're really broken down into what we call like a lifestyle business versus a growth company. And a lifestyle entrepreneur is typically someone who wants to be in business for themselves, wants to make a salary, would like to make some reasonable profits, would like to get some wealth, would like to pass on their business to their kids, but they like the control. They don't want to share decision making. And typically those type of enterprises, they can grow to become very large enterprises, but they're slow. The growth time can be very slow, because you really need a lot of partners, capital partners, management partners, and so forth, to really help you get to the next level. So we as EDCO, we don't really play in that space. There's a lot of small business development centers, a lot of folks who help small business owners with their business plans, getting loans and so forth. But we still wanted just to make sure we kind of cover that piece, because we still get a lot of people that call us and say, well, can you help me with this? And we got to refer them to other sources. But what we're looking for is we're trying to help these communities play in the innovation and high growth spaces. Is really where many of these communities are lacking enterprises that are exporting products out of the region or internationally, and that's why their GDPs are not as strong as other areas. So we're really trying to work with the people there to grow different types of enterprises that don't exist in the area. So depending on what type of company you want to start is how you begin to decide the different types of partners you'll have along the process. And I'll cover this quick slide before I turn it over to Mayte. So this chart here, it basically shows sort of the business cycle, the idea, the business plan, prototype, pilot marketing, and then at some point you start selling, and then at some point you reach profitability. And very generally speaking, we've mapped out the different types of capital sources that entrepreneurs typically use throughout this process. When they're getting started, there are some government programs that will work with startups, but typically, typically commercial banks will not touch you as a startup unless there's a government program that's supporting it, whether it's local, state, or federal. So most entrepreneurs are at the idea stage. When they've got an idea and they need capitals, they're talking to family, friends, and fools, right? That's called the 3 Fs: friends, families, and fools, right? And the reason they use the F is because a lot of the companies don't make it. So the sophisticated investors call it the 3 Fs. But yeah, most entrepreneurs get their start with their own money, their own personal savings, or they raise money from their family. I know Chuck is laughing because he knows what I'm talking about. And then there's, we'll get into some more of the details, but then there's some other downstream. So what we're going to do today is cover a lot of these different types of capital and just at a high level how they work. Okay? So I'm going to turn it over to Mayte for her to start talking a little bit about banks and some of the early stage capital.
Okay. Good afternoon. I'm very pleased to be here for the first time. And I'm pleased to share with you some of the knowledge I got during my years of experience about banking and about how to get your business started. When you first start a business, as Theo said, there is a lot of enthusiasm behind. And of course, it takes more than to be driven about your dream and about ambition. You certainly will need some money to start your business. So it's not only about ambition, it's about, raise some capital to be successful. And of course, to get to know what you're really doing and manage your small business or big business well. Well, this is just what Theo showed a few minutes ago. At the early stage of your business, most of the people who will support you are your friends, family, and fools. And we're just going to go through the advantages and disadvantages of each one of these options. And please, if I get too into the banking language, just stop me and say, Mayte, I don't understand that. Okay? And I will explain that for you. Personal savings are the most popular or primary source of capital for most new businesses. The advantage of having some personal savings is that, of course, no institution will give you some money unless you have some capital, some personal equity invest in your own business. Okay? So most institutions will ask you to put up to 20% of personal savings in your business. So we will need to have some personal savings for that. The disadvantages is that if we don't have that money, it will take longer to start our own business. And the other disadvantages, or I will say what you need to be careful about, is that in the early stage of your business, you will use your personal savings to pay your personal bills, and to pay for your personal expenses. So never forget about, what is going on in your life before putting all those savings in your business. So be careful about that. And, you will get some income from your company when you start to make some profit. Okay? Family and friends. They are your cheerleaders. They know all about you, your dream, what you want to do, and they know you, and most of them will be just dying to give you the money. Most of the time that money is loaned at interest-free or at low interest rates, and in some other ways, your family or friends would like to invest in your startup company. However, what is the disadvantage of this? If you have any problem repaying that money, you will jeopardize your relationship with family and friends. So that's something, a very clear line that we have to be careful about, you know, and that will be something to look at when you decide to, if you decide to just take some money from your family or friends. Commercial lending probably is the most popular, but at the same time is a painful process. Banks are in the business of banking to make money, not to repossess assets. Okay, so I remember when I was working back in Panama, people came to me and said, well, it's good to have some collateral, it's good to have some other assets, but at the end of the day, what I want is my money back. I don't want to handle, to have the problem to handle cars, lands. I'm not in the real estate business. I'm not in the business of selling cars. So, you know, it's sometimes difficult, but they are there because we need them. So, in that sense, there are some secure and unsecured loans. The secure loans are the ones who requires a collateral, such as lands, buildings, or equipment. And the unsecured are the ones that most of us has. Most of us use our credit cards, even in the early stage of our businesses, to finance our businesses. So, as it says here, the secure loan sources are commercial banks, are credit unions, and micro-lenders. And the unsecured are the credit cards and, of course, some friends and families, as we talked before. The banks and credit unions, they are the most common source of funding. As I said before, most entrepreneurs use their personal credit cards to fund their initial stage of their companies. What are the advantages? I may say that we probably have heard about the U.S. Small Business Administration. They will guarantee some loans to small business owners through private banks and other financial institutions. By using money from banks, you will hold the control of your business. You are not losing the control of the business, because most investors, if someone else invests in your company, they will like to have some control on the company too. And of course, it's very important not only to have a good credit history with a bank, but also to develop a good relationship with your banker. That doesn't guarantee that you will have a loan, but that will certainly help. You know, and of course, some disadvantages in that sense are that the approval of a loan request is a very long and painful process, and the only way to make that process less difficult is by having good planning. So if anyone comes to me without a business plan or without very clear financial projections of how that company will repay my loan, it will be difficult for me to give you the loan. And again, banks are there because they want their money back. So that are key things that, and will be my advice to all of you. Planning is very important for banks. Bankers will ask you questions and they will know what are you talking about. If you are just exaggerating your figures, if you are putting a lot of words in your business plans, all they want is to know that they will be able to get their money back. So planning and good financial projections and your ability to repay are key elements. The other disadvantage is that some banks, for example, if you want to open a retail store and that bank has a lot of exposure in the retail industry, probably they will not want to give you any other money because they need to follow certain risk management standards. So they don't want to put all the money in the same pocket. That's all I'm trying to say. That, you know, the bankers will say, well, a percentage of our loans portfolio will belong to this industry, another percentage to that other industry. So that can be a disadvantage too for you. And of course, we all know that credit card rates are high. No? So using our own credit cards can be also expensive. He's the expert in angels and venture capital.
I wouldn't use the word expert, but I'm going to cover a couple of slides here. We're going to get back into the equity side in a moment. But so my understanding, and please correct me if I'm wrong, I know that there was been an attempt to start creating an angel group in the Rio Grande Valley, the Rio Tech Fund. Does anybody have an update on that? But I don't know that it's really taken off. In the border region, the only other angel group fund that I know of is the Camino Real Angels out of El Paso. And they formed, gosh, Jaime, what, 2001? Yeah, and we'll cover a little bit more about that. Now, cities like San Antonio, Austin, Houston, Dallas have quite a bit of angel groups functioning. Some that are much older, they've been around, you know, way more than 10 years, others that are younger. But basically, angel investors, just at a high level, if you have a product, or if you're in the high growth space that I was talking about earlier, like, you know, I want to build a company that's going to be a multi-million-dollar company in 5 years. You know, we want to go out, we want to grow, we're going to expand. You're going to need capital. You're going to need capital for salaries. You're going to need capital for marketing. You're going to need capital for product development. You're going to need all types of capital. So the angel investors are typically experienced business people, typically from the high-tech sector, people that have made money, you know, at IBM and Motorola, or a lot of them in their own startups, technology startups, and they're looking now to be sort of investor mentors in companies. So they form these clubs, and they don't function as a fund. And what I mean by that is they don't all put their money into a pool and say, we're going to invest, you know, this pool of money is going to invest in 10 companies. What they typically do is they have a club, they have quarterly meetings or monthly meetings. People apply, so they go present to the angels. They go to a nice little place, you get a 20-minute pitch, and then if there's individual members of that club that want to invest in your company, they start having one-on-one meetings with you about, you know, your offering, you know, how much, you know, whether they, you know, they start getting into the further details of putting a deal together. The biggest difference between you know, angels and of course the other forms of capital that Mayte was talking about is that these guys want equity, and what that means is they want ownership in your company. You know, we're going to talk a little bit more about them later, so I'll move on. But that's another type of capital access. And then finally, in the world of high growth, in particular technology-based consumer products, where you're going to reach a broad market or international market, a lot of companies bring on what is called venture capital. Now, in terms of venture capital, this is now different than angel investors. One, because they typically invest a little more downstream. They don't want to talk to you unless you're doing, you know, lately they don't want to talk to you unless you're doing $1 million a year of revenue. And they want to help you get your company from $1 million to, you know, 25 million or 50 million, and then they want to sell it or go IPO and, you know, so forth. And this is institutional money, you know, and what that means is that they're raising their money from pension funds, from individual investors, and they're making specific equity investments in companies. They want to be around between 4 to 7 years, and then they want to exit and they want to cash out on that investment. Typical exits are acquisitions, which means a company gets sold to another company. Let's say if you have a good software product, you know, Microsoft might be interested in buying it. If you got a medical product, maybe General Electric wants to buy it. So they work like that. They work on and IPOs. When IPOs are very healthy, and we had a lot of them at Wall Street, a lot of the exits was when the company had enough revenue so they could take it to Wall Street and it would be an enticing investment for the public. So, and there's a small growing community, well, it's been around for a while, but we don't, to my knowledge, we don't have any in Texas, of community development venture capital. And they're sort of the equivalent of what micro-lenders are to the banking industry. Community development venture capital is to the venture capital industry. It's an equity fund, not very big, and they're making investments in companies, but with more of a community focus. So either low-income communities, rural communities, or companies that have very healthy labor practices, or companies that have a double bottom line, like they're solving an environmental problem or a social problem. So they have a different social spin on that. With that, I'm going to turn it back to Mayte to get back into, now that we've covered sort of the different landscape of what type of capital out there, she's going to go into a little bit more detail on how some of the loans typically work, because, and this is important because many of the high growth folks get so excited about angel capital and venture capital, and they lose so much equity in their companies when they could have borrowed for some elements of their companies. So that's still an option even for early stage companies, and I'll let her talk about that.
Okay, back to banking again. Let's put this together. We remember that the different sources of capital are friends and family, our personal savings, and banks. So going back to banks, the sources of those secure loans are micro-lenders. We're going to talk about the small business administration programs and the traditional bank loans. Micro-lenders, they are an excellent source for those lifestyles business startups. What Tio explained at the beginning, the person who wants to just start his or her own business because she or he wants it just to give that back to their family. Most of the micro-lenders define startup companies as the companies that has 6 or less months of operations or in business. So that's the definition of startups. They also require collateral that they can vary between 75 to 1% of the loan amount, depending on the amount and depending on what you want to use the money for. They will give you money for working capital. Working capital is the money that you need in order to run your daily operations, as paying payroll and other account receivables and suppliers. And the advantage of micro-lenders is that they will give money to startup companies even if they don't have a financial history. That's why they are more expensive than traditional banks, because their risk is higher. And of course, again, they will require you to have a business plan, and financial projections. It's not that they will give you the money without looking at that, but they will give you the opportunity to have some money, even if you don't have a financial credit history. The amount of the funding is slower, of course, and we are talking about maximum amount of $100,000 and usually under $50,000. Yes. The interest rates are from 10.5% up to 18%. There are some institutions like Action Texas that will speed the process, and you will get the loan from 2 to 3 weeks. And the maturity or the term of the loan will be up to 120 months. The Small Business Administration, they have 2 very popular programs. The 504 program. This is just for buying or getting equipment, land, or buildings. So it's not for working capital. They will not give you money for working capital, but they will for getting land, building, and equipment. How does this work? They will work in conjunction with the commercial bank. The commercial bank will lend the 50% on the loan. The Small Business Administration will give 40% of the loan, and of course, you will need to put some money from your pocket, and that is generally 10%. And of course, they will give money to companies that are for profit only. As Theo mentioned before, if an entrepreneur wants to get some equipment and land, it's better to get the money from this kind of program instead of asking angels investors to give you the money for that. And as he mentioned, the advantage is that you will not need to give the ownership of the control of your company, because you can get the money from the bank and just keep your ownership. All banks have 500 loan specialists, and the micro lenders will have 1, 2, and those companies needs to be certified development corporation by the Small Business Administration. The other program that the Small Business Administration has is the 7A program. The funds can be used for assets and for working capital. Again, they will require some collateral from you, and there will be specific terms that be negotiated between the commercial bank and the Small Business Administration. The bank is the institution that is giving the money with the guarantee of the Small Business Administration. So, of course, between the two, they need to negotiate the terms and conditions of the loan, and they have requirements that the owners will need to meet. The Small Business Administration can guarantee up to 85% on loans up to $150,000, 75% on loans of more than $150,000. Maximum amount will be $2 million, and the maximum guarantee to the lender will be $1.5 million, or 75% of the total amount. They will guarantee up to 75%. The maturity will be based on the ability to repay. Again, that's why we need to have strong financial projections. And of course, what is the purpose of the proceeds and the useful life of the assets that will be that will serve as collateral. The maximum maturity will be 25 years for real estate and equipment, and 10 years for working capital or inventory loan. And traditional banks, it's very hard to get a loan from a traditional bank without the guarantee of the Small Business Administration. Typically, they will require the entrepreneur to put a collateral from 30% up to 70% of the value of the loan. And as we all know, banks always lend you money when you don't need it and turn you down when you need it. So that's the risk we take when we go to banks. And I think that this will be very useful for you. These are the two local offices of the Small Business Administration close to this area. And I just added this information in case you want to approach or to know more about the details of any of these two programs. Do you have any questions? Okay. Well, I'm very glad to be here.
How are we doing on time? We've still got 10 minutes? Well, we're still not done yet. We've got a few more slides. I think we got, 10 minutes, Jackie? Okay. And I want to introduce another person that was going to arrived just in time. He was some flight delays, I guess. But Jaime Aguirre is here from Austin. He flew in today, and I just want to read his bio quickly, and then he's going to cover some of the sort of VC-related work. So Jaime Aguirre joined Austin Ventures as a senior associate in 2008. Prior to joining Austin Ventures, he was a vice president at Goldman Sachs in the technology, media, and telecom investment banking group, where he focused on mergers and acquisitions, financing transactions in the technology industry. Jaime's prior work experiences include Merrill Lynch in Mexico City, where he advised companies on mergers and acquisitions, capital raising, and buyout transactions. Earlier in his career, Jaime worked in the energy group at Merrill Lynch, and he also spent time auditing companies at Arthur Andersen. He is a native of El Paso, where he graduated from Austin High School.
That's right.
And he got his bachelor's in business administration from UT Austin, and he has his MBA from the Harvard Business School. So I want to thank Jaime for joining us, and you feel good to go? Or
yeah, I'm not sure if I'll go through the slides. Maybe I'll just cover some topics, and then we'll wrap up with some of the slides. Does that make sense?
Well, why don't you cover your topics first? And then
All right, good. Well, thanks for having me. I'm glad to be here. As Dale mentioned, I am from the border, and I'm always glad to get back to the region. I think this is not a region that has a lot of opportunity, and one where angel investing and venture capital and private equity in general just hasn't had much of an impact, and I think can have a tremendous impact. And I think I'd like to make this interactive. If you guys have particular questions, we just go ahead and throw them out there. But I think one way to kick this off, and that Dale mentioned a good topic maybe to start off with would be kind of what is venture capital, what is private equity, and I think a good way to kick that off is just an example of what we do. And I'll start with a company that we work with at Austin Ventures. It's called HomeAway, and just walk you through a little bit of a case study as to what the history of that company was and how we're working with them. And that'll give you a good idea for how maybe your company or other similar companies may be able to work with a venture capital or a private equity firm. So HomeAway is a company that Austin Ventures started working with about 4 or 5 years ago. And it was really a very basic idea. The idea was the guys who have, or women who have vacation homes or second homes, and they rent them out. So Padre Island, people have their second home, and they rent them out, and they used to rent them out through the local real estate agent or through the local classified ads. And you think, well, that's kind of a sleepy, interesting little business, not a lot there, probably not something that you'd put a lot of money into. But the idea was hatched that what if we added all of those up and consolidated that segment? And so we worked with a couple of executives that Austin Ventures had worked with in the past to explore that idea and see if we couldn't add technology and add some professional management to a sector that previously was just a lot of mom and pop shops. And so it started with just a few places, I think a couple of them here in Texas, and we consolidated a couple of them, tested out some technology, bought a couple of other sites, and continued that process. And it went from a startup where we invested, I think, $200,000-$300,000 just to test out the technology, all the way up into a company that is today, which is valued at over $1 billion. And that's, I think, just a very simple case study of a situation where a couple of guys have an idea, they come to a venture capitalist or a private equity firm, together they put the idea together with some capital, together with other executives, and you fast forward 5 years, and they I don't know if you guys may have noticed, they had the ad on the Super Bowl with Chevy Chase, and they did where he's going into the hotel. He's like, the hotel sucks. I'd rather go to a house, and they go stay at the house, and that's the company. And so I think that's just an overview of a case study of what we do on a. I'd like to say all of them would work out that way. They definitely don't, but that's a simple case study of kind of what we're up to. And maybe also it'd be good to describe Austin Ventures and what Austin Ventures does as a firm. And I think it's a very simple example of all or it's representative of all venture capital firms and private equity firms. So we've been around for about 20 years. Obviously, I haven't been there for that period of time. The firm currently has about $4 billion of assets under management. And the way that we work is we raise funds from our institutional investors. So, for example, the University of Texas is an investor in Austin Ventures, and we raise in funds. Our last fund was a $900 million fund. So our job is to take that $900 million and find small companies, entrepreneurs, and help them grow. We divide our business up into two practices. One is the venture capital practice, and the other is the private equity practice. And on the venture capital side of the business, these are early stage companies. They're usually Texas-based. They can be anything from an entrepreneur with an idea to a company that's already somewhat profitable but just needs more money to grow. The typical investment size on the venture capital side of the business is about, on the small end, $200,000 to $500,000, all the way up to $20 million. And what we're trying to do there is we try to prove out an idea. We try to get the management team in place that can run the play, and we try to expand into new markets, or either geographic markets or product markets. We typically work in technology-focused businesses, or technology-enabled businesses. And examples of the sectors that we spend a lot of time in are software. We do a lot in information services. We do a lot in media. Where we don't play is oil and gas. We don't do real estate. We don't do asset-intensive plays. I think I made this comment of, if you've got assets, if you're looking for equipment, if you're looking for working capital, venture capital firms is not the place to go. I think when the right time to come to a venture capital firm is if you're looking for a partner. So we don't make our money off of an interest rate. We make our money off of growing the business, becoming an equity partner with you. So you've got to be willing to give up some of your company. And the situations where that makes sense is if you're looking for, again, growth capital and you don't have assets, so you don't have real estate or equipment that you can get financing from, but you want to go into a new market, or you have an idea that you want to expand upon, that's when you come to a venture capitalist who's willing to take that bet. On the growth equity side of the business, I don't have a good sense for the types of business that you guys work in, but on the growth equity side of the business, it's a little bit bigger. So this is a situation where you've already got a profitable business model. It's already been proven out. You've already got an established team. You've got anywhere from, on the low end, $2 to $3 million of profitability, all the way up to $20 million of profitability. The checks on the growth equity side of the business are larger. We write on the small end $15 to $20 million equity checks, all the way up to about $100 million of equity. So we can finance pretty good-sized companies. But again, on that side, you need to be proven out and profitable and have the team together. I would assume that most of the people in the room here are probably more leaning on the venture capital side of the business. And so, I'm not sure where we want to go from here, but I thought a couple of topics that might be helpful is, business plans and what they look like, and when the right time is to come to a venture capital shop, and what you need to show when you show up. And I think there is no definitive business plan and game or template to come to a private equity shop in terms of what you need to show. But I think it's helpful to keep a couple of, and you need to be able to answer a few questions. And one is kind of, what problem are you solving? We sometimes have people come into our shop and they have a good idea, but they haven't really fleshed out who they're selling that idea to, or how they're going to make money off of that idea, or what problem it is they're solving. So I think that's one really good place to start. Another is kind of, who are your competitors, and why are you going to be able to differentiate yourself against those competitors? I think you've really got to be able to nail that down. Another one is the market size that you're going after. When you come to a venture capital shop, it's got to be beyond a local opportunity. I think a lot of times people come in and they've got a really good idea to be the best in a certain market, in a certain geography, and that's just not where venture capital does very well. I mean, we're really looking to expand into other markets. Like the case study that I gave you, it was, just to give you an example, I think the first guys that they started with may have even been in Corpus Christi. It's just, here's a small little idea, but here's why it can go on. I mean, the last acquisition that we did, even though it started in Corpus Christi, I think we ended up, the last acquisition was in Brazil for $3 million. So it's an idea that maybe might be local, but that you can take and expand somewhere else. And I think that's a good, you've got to come in to the shop with an idea of how you're going to take that into other markets before you, you're going to be able to get some venture capital financing.
Comment I made earlier. I know that Austin Ventures as a firm does have lower years in the industry. You see people still working on the next half a million investment, still making larger investments, or at what stage do the companies have to be? Some companies have an idea, but our experience has been that a lot of the VCs were not really talking to people. I know there's different folks.
Yeah, so I think, I mean, for those of you in the back who weren't able to hear, it's like, what size do you have to be before a venture capital firm will be interested? And I think it is a fair point that under $500,000 is probably not something that most venture capital firms are going to look at. And that's just a simple matter of math. We've got our mandate from the people who invest in us is to put to work $900 million. There's only 15 to 20 of us in the shop who work on investments. So it just makes sense that in order to put $900 million to work, it's hard to do that when you're doing $100,000, $200,000 investments. And it's just a lot tougher to make the returns. Like, HomeAway is going to be worth, we hope, $1.5, $2 billion. It's already been valued at over $1 billion. And it's a lot harder to get there when you're starting out at $100,000. So I think maybe the question behind the question is, like, when do you go to an angel investor versus a venture capitalist? And I think you've really got to get up to over $500,000 before most venture capital firms will start to get interested. Now, that being said, there's some good examples of opportunities, especially within universities or tech-focused opportunities, where there's a really big market size, and it only doesn't take that much capital to get them started. So on the software side, we have made investments of under $500,000, but that's usually in situations where they've got just a great technology that's going to move a market. So I think $500,000 is probably a good place to cut out. That's on the investment side. So on the revenue side, we really don't have a threshold, because again, there are ideas where there is no revenue yet, and we still will look at pre-revenue companies. It's rare, and it's all in the technology space. People have ideas to do services or real estate or construction or anything of that sort. You need to have a significant amount of revenue. The only time I think it makes sense, or where you're likely to get any attention on a pre-revenue business, is if there's a technology component to it. On a non-technology business, yeah, you need to get revenue probably even higher than $500,000, probably closer to $1 million before it makes sense to start calling around to the venture capital firms.
I'm just going to make a couple comments. Thanks to the audience, because we have to wrap it up.
Yeah.
On that side, I'm really happy to hear that Austin Ventures is we haven't interacted with a lot, but is still doing stuff at idea, conception. A lot of the other folks we've been talking to around the country have moved further downstream. But it's really up to the money manager and what their strategy is. So it's sometimes on a case-by-case basis. We got to wrap this up. I know we're all going to be outside here for 30 minutes, and then we have a panel of entrepreneurs talk about their experiences starting their companies, and why they chose what the path they've chosen. But if you have any questions for us, we'll be right out here. So I want to thank our presenters, and thank you for having us.
Okay, so real quickly, we've given you pretty much everything that we can today to help you get going with entrepreneurship. But the one final thing that is essential for anybody that's thinking about entrepreneurship is to speak to people who are actually doing it, who are actually in the mud and are digging their way to the top. That doesn't really make sense, but you get what I'm saying. we're going to have a break. If you need to speak to Rapid Response Manufacturing Center, EDCO, TMAC, any of these resources that we're providing you today, please, they all have tables. You can get more information out there, and then we'll come back in and wrap it up with our panel. Thank you.